Welcome to Dukascopy TV. I'm Elaine Stenson. Brazil's real fell on speculation the central bank will limit the rollover of currency swaps that have supported the world's biggest two-month rally. Gustavo Arteta from UBS in New York joins me now on the line. Gustavo, the currency depreciated 0.8% to 2.1905 per US dollar. Swap rates on the contracts maturing in January 2015 dropped 4 basis points. How concerned should we be about this?
I don't think we should be concerned. I think it's an expression of the reality of that conditions and circumstances have changed somewhat. That intervention program of pre-announced purchases of $60 billion, or rather intervention of $60 billion combined in swaps and credit line auctions, was aimed at containing the volatility and the rapid weakening of the real when or ahead of the high expectations that the market had that the Federal Reserve would begin tapering in September, right? And the program was successful in terms of reducing the volatility significantly, and it also helped bring the BRL, dollar BRL, down a little bit before the Fed. As the Fed decided not to make any decisions regarding purchases of assets, the intervention program continued to provide support on the downside to dollar Brazil. Right, and so subsequently, the fact that the U.S. Treasury yield, 10-year yield, declined on the lower expectations from the Fed. All of EM currencies in general and LATAM currencies in particular have strengthened on the back of that. Over the last few days, yesterday's print from the payroll print in the U.S., particularly once again, I think convinced portions of the market who still had, I don't know if to call it hopes or expectations of tapering maybe December, maybe January. And I think the whole schedule of potential moments for initial tapering of the Fed have moved back. So that has opened a window of opportunity for people that I think are changing benchmarks or trying to make up for losses that they incurred in the spring and summer when they were caught short against the dollar when the dollar gained strength. So I think we have to put it in that context. I don't think it's worrisome in the extent that the central bank could make various decisions. That program did not entail a commitment to the rollover. So it has that availability, and right now it has, if I'm not mistaken, somewhere around close to $8 billion, or it had until yesterday, close to $8 billion of rollovers due in November, and a slightly similar amount in December. So the central bank, in order to contain the additional strengthening of the real in the last few days, could certainly decide to do that. I mean, I think that the central bank still would like to maintain that program in place to provide support to the credibility of the institution in terms of it announced that it commits and it's going to meet that. At the same time, I don't think the market would punish it too much if it would come out and argue that the circumstances have changed. The Federal Reserve is extending its easing bias, etc., and withdraw it. I think it would be a very tough decision for the central bank to do that. And that's why the first steps to avoid that would be to maybe not roll over the swaps due in November and December.
Alexandre Tombini intervened in the currency through swaps last August with a $60 billion campaign that saw Brazil's large external reserves rise more than 12 times since 2000 to $373 billion. Gustavo, some are saying that this program was too successful. How would you respond to this?
No, it was as successful as it was supposed to be. It has contained volatility. It led to a very decent move, about 6% from the highs in August into September. But what we're seeing now is not a result of the intervention program. It's a result of U.S. rates going down at the same time that Brazil is offering very high real interest rate returns with its hiking cycle, right? So I don't think $500 million a day on the swaps is not enough to cause these moves. I think you've even seen the moves are continuing, right? And the move on the currency has accelerated while the program has been steady. So you can't say that it is the program that is causing this. Sure, it's providing further support, but the move has been as a result of changing world conditions. So I think by saying that it's been too successful, it would be making trying to put a value judgment on the value of the intervention program. I think the intervention program is doing what it's supposed to do. It just right now it's confronting to a new condition in external markets that it's leading to further strength than what I think the government particularly would feel comfortable with.
There's also talk of tensions between the central bank and the finance ministry, which wants a weaker currency to help Brazil's flagging industry. One side always wants lower inflation, while the other side wants more competitiveness. Where do you stand on this?
It's a fact that they've been, ever since they broke from the coordinated efforts that we had until the beginning of the year, regarding the currency and the balance that they have to strike in terms of fighting inflation and promoting nominal competitiveness, that there's going to be this tug of war, I think, and that's why I think the central bank is more comfortable, or could be comfortable, with exchange rates slightly more appreciated. Let's say, roughly in a range between 210 and 225. While the government would like it to be between minimum 215 and up to 230. In reality, they would love to see it at 240. But within those differences of opinions, there is a range where both would be, roughly comfortable with or can live with. In the words of Mantega, who said, when the currency was about 220, he said, we can live with this. I mean, those were his words, which is not to say that they're happy with it. The issue, I think, that is very critical to understand in this debate is where you have to look at the real exchange rate. And the real exchange rate today is right around the same level that it was at the peak of 2012, which is the level to which the government took and the central bank took by devaluing the real to promote competitiveness. So we are around the same real exchange rate levels that we were at that time. So that's why I think the government is content. The central bank is comfortable because it knows it's within a hiking cycle, combating inflation. So the two effects, I think, mesh a little bit. Certainly, when we see the currency reach or fall to about 215, we clearly see these tensions coming up because the government begins to feel uncomfortable because the squeeze on growth from appreciation and from the rate hikes are doubling up on its efforts to keep the little bit of growth spurt that we've seen the last few months probably get hurt.
Gustavo, thanks for joining me on the line today. And that's all for now, but I will be back later with today's Commodities Corner. Bye for now.